Good afternoon. Before we begin, an important reminder. This presentation and the associated webcast are for informational and educational purposes only. Nothing here should be interpreted as a recommendation to buy, sell, or hold any security, nor as personalized investment advice. The figures and charts we reference are compiled from sources we consider dependable, but markets and economic series can be revised, and conclusions will evolve as the data evolves. I also want to be transparent about alignment. Pries Capital, and I personally, may have exposure to some of the asset classes, strategies, or companies referenced today through our own portfolios, projects, or research programs. That does not change the discipline of our process. It simply reinforces that we approach this analysis the same way we expect you to, with accountability to risk, an eye for regime change, and a commitment to evidence over narrative. Now welcome to Pries Capital's end of Q4 2025 Economic Research Briefing, released in January 2026. I'm Jason Pries, CEO of Pries Capital. The job today is simple. Translate a complex set of cross-asset signals into a positioning plan you can execute with conviction. Q4 was not just another risk-on quarter. Under the surface, we saw leadership narrow, dispersion widen, and macro data send mixed messages. Inflation cooled, but wage growth stayed elevated. The labor market softened, but remained resilient, and rates shifted in a way that matters for both equity multiples and fixed income carry. This is exactly the type of environment where investors are tempted to overfit to the last 12 months and underweight scenario analysis. Our approach is different. We treat markets as an auction of risk, not a scoreboard of headlines. We start with breadth, concentration, and valuation. We cross-check that against the cycle of growth, inflation, employment, and leading indicators. And then we stress test portfolio exposures against the bond market's message, because rates are the true discounting mechanism. By the end of this briefing, you should have three things: a clean read on what actually drove Q4 returns, a macro checklist for what changes the game in 2026, and a risk-managed framework for diversifying away from the most crowded exposures while staying positioned for upside if the cycle extends. This section is the market data foundation, charts and tables that summarize what happened across key stock market indicators and asset classes over the latest quarter. I want to emphasize how we use this material. These slides are not meant to be read like a performance report. They are meant to be used like an operating system. Performance is a signal, not an answer. When indices rise, the first question is not how much, it's how broad. When sectors diverge, the question is not who won. It's what is the market pricing about growth, inflation, and liquidity. And when bonds rally or sell off, the question is not is the Fed done? It's what is the discount rate doing to future cash flows and to risk parity between asset classes? So as we move through the market review, I will call out three recurring themes. First, concentration. How much of the return stream is dependent on a small group of names or factors? Second, valuation. Whether price is running ahead of fundamentals and whether multiples are leaving little room for error. Third, diversification quality. Which assets actually provided ballast and which failed to diversify when it mattered. If you are a financial advisor, think of this as the evidence you use to defend portfolio decisions to sophisticated clients. If you are an investor, treat it as the diagnostic panel, helpful not because it predicts the future, but because it tells you where risk is building and where opportunity is emerging. Let's start with key stock market index performance for Q4 2025. In the United States, the Dow Jones Industrial Average delivered a total return of roughly plus 4%, while the S&P 500 and Nasdaq Composite were up about plus 2.7%. Internationally, the quarter actually looked stronger. The critical interpretation is not that everything was positive, it's that leadership broadened outside the U.S. during the quarter. That matters because the prior regime had been dominated by U.S. mega-cap growth, and diversification had felt unnecessary to many allocators. Q4 was a reminder that relative leadership can rotate quickly when the dollar weakens, rates stabilize, or when valuation gaps become too obvious to ignore. From a portfolio standpoint, this is a constructive development. When global indices lead, it tends to improve the efficiency of diversification and reduce single market risk. It also supports a more balanced equity allocation, one that's not overly dependent on U.S. large-cap multiples expanding further. The tactical takeaway: if you have been structurally underweight international developed and emerging markets, Q4 provided evidence that you can add exposure without sacrificing return potential. But do it deliberately, size it against currency risk and pair it with quality balance sheets, not leverage-sensitive cyclicals that break when growth stalls. This continuation slide places Q4 in context with trailing 12-month returns from December 2024 to December 25. 2 points matter here. First, the year's returns were strong, but they were not uniform. The spread between the Nasdaq and the Dow reflects a market that rewarded duration, long-dated growth cash flows, far more than traditional, lower multiple industrial exposure. Second, the note on the right chart is crucial. Despite a promising start to Q4, momentum faded in the final 2 months. Indices finished the year slightly below their highs, while global markets held more firm. That pattern, strong early quarter then a stall, often signals that liquidity and positioning did the heavy lifting, and that incremental buyers became more selective as valuations rose. It does not guarantee a decline, but it raises the importance of risk control going into 2026, because upside becomes more dependent on flawless earnings execution and benign rates. Strategically, when you have a year like 2025, don't confuse it with a new normal. Use strength to rebalance, harvest gains, and rebuild diversification. Late cycle markets punish complacency, not participation. Here is U.S. stock sector performance for Q4 2025, and it's one of the most important slides for understanding how the market is thinking. Healthcare was the standout, up roughly plus 11.7%, a meaningful outperformance versus the broader market. Technology and financials were modestly positive, with materials, energy, and industrials all slightly positive. On the downside, defensives and rate-sensitive sectors lagged. Utilities fell about -1.4%, and real estate was down roughly -3.2%. Consumer staples and discretionary were essentially flat to slightly negative, and communication services was slightly negative. What does this mean? It signals a market that is selective, seeking earnings durability and idiosyncratic growth rather than broad cyclical expansion. Healthcare leadership suggests investors are paying for resilience, innovation pipelines, and defensive cash flows. Meanwhile, real estate weakness reflects the persistent headwind of higher discount rates and refinancing risk, even as the market debates the pace of future Fed cuts. For portfolio strategy, this is a caution against simplistic factor bets. Growth versus value is less useful than balance sheet strength versus leverage, and pricing power versus margin compression. If you are overweight rate-sensitive equities purely for yield, Q4 was a reminder that yield can be a trap when funding costs remain high. The actionable takeaways are to be tilted towards quality sectors with durable cash flows, and be selective in real assets, prefer inflation-linked pricing power over leverage-dependent equity REIT exposure. This table summarizes asset class performance across trailing periods, 3, 5, and 10-year annualized returns, alongside the most recent quarter and the last 12 months. One message stands out from Q4. Apart from real estate, equity-based asset classes were broadly positive, and international equities led the quarter. Stepping back to the full year, the S&P 500 finished 2025 with a total return of approximately plus 17.9%. That's strong, but what's more interesting is how leadership is shifting. When international and value lead simultaneously, it often reflects a regime where the dollar is softer, energy and materials stabilize, and investors begin to pay attention to valuation rather than story. For advisors, the practical use of this slide is portfolio benchmarking. If a client is anchored on U.S. large cap growth because it worked in prior years, these numbers support a broader, more global allocation, particularly if the U.S. market is priced at elevated multiples. It also reinforces the role of diversifiers. When equities are strong, diversification feels expensive. But late cycle, diversification is what protects the compounding machine. Now when it comes to the portfolio implications, maintain equity exposure, but rotate toward areas where returns are supported by valuation and breadth, not just multiple expansion. Increase international exposure thoughtfully, and avoid treating real estate as a default diversifier until rates clearly normalize. This quarter-by-quarter view of asset class performance across the last 15 quarters reinforces the concept of regime shifts. Q4 2025 is a clean example. The interpretation is that Q4 produced a relatively balanced tape across equities and bonds, an important contrast to earlier quarters when correlations often moved higher and diversification benefits weakened. International strength suggests a tailwind from currency dynamics and relative valuations. Bonds contributing modestly suggests rates were not a headwind during the quarter, which matters for balanced portfolios. But the real signal is the persistence of dispersion. Over 15 quarters, leadership rotates aggressively. That is the case for building portfolios around a repeatable process rather than a single thesis. If you can't predict the next leadership rotation, and no one consistently can, the only defensible path is to own multiple return streams and rebalance. As portfolio guidance goes, keep a strategic allocation to diversified equities, but pair it with rate-sensitive ballast and selective real assets. For clients who are return chasing, this chart is your argument for patience. Diversification is what keeps you invested through volatility and prevents forced selling at the wrong time. This slide examines diversified portfolio outcomes over the trailing 12 months, specifically allocations that blend the S&P 500 with the Bloomberg U.S. Aggregate Bond Index. The results are straightforward. The higher the equity weight, the higher the return over this period. A 100% S&P 500 allocation returned about plus 17.9%. An aggressive 80-20 blend returned about plus 15.8%. A balanced 50-50 portfolio delivered about plus 13.8%. And a conservative 20-80 mix returned roughly plus 9.5%. Here's the important nuance. These figures represent a strong equity year. In years like 2025, investors are tempted to conclude that bonds are unnecessary. That conclusion is exactly what sets up the next drawdown. The purpose of bonds in a diversified portfolio is not to beat equities in equity bull markets. It is to reduce max drawdown, dampen volatility, and preserve the ability to rebalance into equity weakness when forward returns are typically highest. While the slide also references max drawdowns, the lesson is conceptual. Risk management is path-dependent. Two portfolios can end with similar long-term returns, but the one with a smaller drawdown is the one that investors can actually stick with. Behavioral discipline is an asset. As a portfolio takeaway, if your clients are overweight equities after a strong year, rebalance. Maintain a bond allocation size to the client's true risk tolerance, not their optimism during a bull market. And if rates become more supportive, high-quality duration becomes a strategic tool, not a concession. Equity-style performance in Q4 2025 shows a subtle but important message. Value outperformed growth. Large cap value returned about plus 3.8% and small cap value about plus 3.3%, while small cap growth and large cap growth were closer to plus 1.2% and plus 1.1%. In the companion index view, the Russell 1000 was up about plus 2.4% and the Russell 2000 about plus 2.2%. Why does that matter? For much of the prior cycle, growth leadership was driven by falling rates and multiple expansion. When value begins to lead, it often signals either rates are not collapsing, earnings are becoming more important than narratives, or investors are seeking margin of safety due to macro uncertainty. In Q4, you can make the case that all three factors were in play. For portfolio strategy, a value tilt can be a risk reducer when valuations are elevated. Value indices typically carry more cash flow-rich businesses, higher dividend contribution, and less duration sensitivity. That does not mean you abandon growth. It means you manage concentration and valuation risk more intelligently. The Russell 2000's positive performance is constructive, but it's not confirmation of a small-cap renaissance. Small caps are still more sensitive to credit conditions and refinancing risk. So the right posture is selective exposure. Favor profitable small caps with strong balance sheets, avoid heavy leverage, and pair any small cap allocation with a credit or volatility hedge. Overall, Q4 supports a modest rebalancing toward value and quality, especially if client portfolios are overly dominated by the most expensive growth segments. This is the S&P 500 valuation reality check. As of December 31, 2025, the CAPE ratio is approximately 39.9 versus a historical average around 17.7. The standard PE ratio is about 28.6 as of September 30, 2025, above its historical average near 24.5. The operating PE is roughly 26.3 versus an average around 19.6. The direction is clear. Valuations are elevated relative to long-term norms. Now, valuation is not a timing tool. Markets can remain expensive for extended periods, but valuation is a very useful risk tool. High starting valuations tend to lower future long-term expected returns and increase vulnerability to earnings disappointment or rate shocks. When the market is priced for perfection, the distribution of outcomes becomes asymmetric, more downside than upside. The slide also points to a key driver: earnings concentration among the largest index constituents. When a small number of companies carry outsized earnings growth and market cap, the index begins to behave like a concentrated portfolio. That has two implications. First, passive exposure is less diversified than investors assume. Second, the market's multiple is heavily influenced by the valuation of those top names. As it comes to portfolio guidance, treat U.S. large-cap passive exposure as a core only if it is paired with diversifiers, international equities, value, quality small caps, and non-equity hedges. If you are underwriting private deals or growth equity, assume a higher discount rate regime and demand a wider margin of safety. Elevated public valuations change the opportunity cost of capital. We now transition into the macroeconomic data section, leading and lagging indicators and the trends from key economic reports published recently. This is where we separate the market's narrative from the economy's reality. Think of the macro dashboard in three buckets. First, inflation and wages. These tell you whether the Fed has room to cut without reigniting price instability. Second, employment and consumption. These tell you how resilient demand is and whether the consumer can keep carrying growth. Third, leading indicators. These tell you where the cycle is likely headed, not where it has been. The purpose of this section is not to declare recession or no recession. It is to quantify the probability distribution and identify what would change that distribution. If inflation falls and the labor market weakens gradually, the soft landing path remains viable. If wage growth stays sticky and unemployment rises faster than expected, policy becomes constrained and risk assets reprice. For portfolio strategy, macro data is most useful as a trigger framework. You are not trying to outguess every print. You are building guardrails. When certain conditions are met, you reduce leverage, rotate toward quality, extend duration, or increase hedges. Conversely, when conditions improve, you redeploy risk systematically. As we go slide by slide, I will highlight which metrics are signaling late cycle risk, which are improving, and where markets appear to be pricing a more optimistic outcome than the data supports. This is the foundation for the Pries perspective going into 2026. Inflation and wage growth are the center of gravity for 2026 policy risk. As of November 2025, headline inflation is approximately 2.71% and core inflation is about 2.66%, with the CPI index level around 324. That is meaningfully lower than the peaks of the prior cycle and, on the surface, it supports the market's belief that the inflation problem is solved. But the wage side tells a more nuanced story. Average hourly earnings are at an all-time high around 37.02, with year-over-year wage growth near plus 3.76%. Real average hourly earnings are improving, but only modestly. Real wages are up about plus 0.89% year-over-year. This mix of cooling inflation, still elevated wage growth, often produces sticky services inflation, because labor is the dominant input cost for services. The portfolio implication is straightforward. The Fed may be able to cut, but it may not be able to cut aggressively without risking a re-acceleration in inflation. That matters for equity multiples and for long-duration assets. Investors who are positioned for a rapid return to near-zero rates are making a fragile bet. For advisors, this is the conversation with clients. Disinflation is supportive, but wages define the terminal rate path. Maintain equity exposure, but avoid overpaying for long-duration growth purely on the assumption of falling rates. In fixed income, favor high-quality carry while you wait for clearer evidence that wage growth is moderating sustainably. And keep inflation hedges, select real assets, commodities exposure, and pricing power equities because the tail risk is not deflation, it is a second wave of inflation pressure. Employment is where the macro cycle either confirms resilience or reveals fragility. As of December 2025, non-farm job openings are approximately 7.15 million. The unemployment rate is about 4.4%, and labor force participation sits near 62.4%. Those numbers reflect a labor market that has cooled from peak tightness but remains functional. The key is directionality. Unemployment is drifting higher, and openings have come down from prior highs, which typically signals that bargaining power is slowly shifting away from labor. On the separation side, as of November 2025, quits are roughly 3.161 million with a quits rate around 2%. Layoffs and discharges are about 1.687 million with a rate near 1.1%. Quits are one of the best real-time indicators of worker confidence. When quits trend down, it often precedes slower wage growth and weaker consumption. Layoffs remain contained, which supports the soft landing narrative, but the asymmetry is important. Layoffs can rise quickly once margins compress. As a portfolio strategy, treat the labor market as a trigger, not a headline. If unemployment moves from the mid-4s toward the 5% handle, recession probability rises materially, credit spreads typically widen, and equity volatility increases. That's when you want duration and quality, before the move, not after. For equity exposure, emphasize companies with pricing power and low labor cost sensitivity. For credit, avoid reaching for yield in lower quality issuers whose default risk increases when employment weakens. And for advisors, frame it clearly. A cooling labor market is not bad. It is the mechanism that allows inflation to stay down, but it also increases the chance of an earnings recession. Balance matters. This leading indicator dashboard is especially important because it aggregates signals across rates, sentiment, manufacturing activity, inventories, housing, and retail sales. The notes also mention that a lapse in federal funding delayed or suspended some series, so we interpret with appropriate humility. Even with that caveat, the pattern is clear. Several forward-looking indicators are soft. As of Q4 December 2025, the 10-2-year Treasury yield spread is about plus 0.71%. That's notable because it has normalized after a long inversion, an inversion that began in July 2022 and only normalized in September 2024. Historically, the normalization phase often occurs as growth expectations weaken and the market anticipates easier policy. Survey data is negative. The New York Fed Business Leaders Survey current business activity is around -20, and the Philly Fed Manufacturing Activity Index is about -10.2. Consumer sentiment is low near 52.9. On the other hand, retail sales are still positive. Year-over-year retail sales change is roughly plus 3.1%. Housing starts and permits are present but must be contextualized with rate sensitivity. The portfolio message is risk asymmetry. Equities can continue higher in the short run, but the leading data suggests the probability distribution is widening. More paths that include slower growth or recession. That's when you tighten your process, rebalance, reduce leverage, and upgrade quality. When it comes to actionable guidance, keep exposure to equities with durable earnings, but increase allocation to ballast, high-quality duration, and liquidity. Avoid over-allocating to economically sensitive credit. Use this dashboard to communicate to clients that the economy is fine is not the same as risk is low. Risk is rising when leading indicators stay soft while valuations remain elevated. GDP and public debt are the long-cycle backdrop behind both monetary policy and market volatility. As of Q3 2025, nominal U.S. GDP is approximately $31.1 trillion, with real GDP around $24.03 trillion. The reported quarter-to-quarter GDP percent change from Q2 to Q3 is about 8.3%. Regardless of the exact methodology behind that figure, the key point is that nominal growth remains supported by both real activity and price levels. Now compare that to public debt. As of Q2 2025, the latest available in the report, U.S. public debt is about $36.21 trillion, which equates to roughly 118.8% of GDP. That is not a political statement, it is a market fact. High debt to GDP has two direct investment implications. First, it increases the sensitivity of fiscal policy to interest rates. Higher rates mean higher debt service costs, which can crowd out discretionary spending or force higher deficits. Second, it creates a structural incentive for policymakers to prefer financial repression, keeping real rates below inflation because that is the easiest way to manage the debt burden over time. For portfolio strategy, this strengthens the case for diversification into assets that are resilient to fiscal instability. Real assets, commodities, select infrastructure, and precious metals. It also argues for owning high-quality duration as a hedge, but with a clear understanding that long-term inflation risk remains a tail risk due to fiscal dynamics. In practical terms, don't build portfolios that depend on a return to the old regime of permanently low rates and low volatility. The debt math makes that regime unlikely. Build for a world where inflation risk and policy risk are recurring features, not one-off events. The U.S. trade balance provides another lens on growth and currency dynamics. Through Q4 2025, U.S. exports of goods and services were approximately $862 billion, while imports were around $1 trillion. That produces a trade balance deficit of roughly -$178 billion. A sustained deficit is not inherently negative, but it is a signal. The U.S. consumes more than it produces, and the gap is financed through capital flows. The bottom table highlights trade activity with key partners. One example in the notes, exports to the European Union in Q3 2025 were about $193 billion, up roughly 17% from Q3 2024. That matters because it suggests external demand held up better than many expected, consistent with the international equity outperformance we saw in Q4. For investors, the trade story connects to the dollar. If the U.S. runs persistent deficits while fiscal deficits remain large, the dollar can face structural pressure, especially if global growth improves and capital flows diversify. Dollar weakness tends to be supportive for international equities and emerging markets, and it is also supportive for commodities and precious metals. When it comes to portfolio implications, if your allocations remain heavily U.S.-centric, you are implicitly making a dollar strength bet. Q4 suggests that bet may not be one-sided. Consider a measured increase in global equity exposure, and where appropriate, use currency-hedged vehicles if client mandates require it. For real assets, recognize that commodities and metals can serve as both inflation hedges and dollar weakness hedges. The trade deficit is not a near-term catalyst, but it is a structural factor that shapes return leadership over multi-year horizons. Housing is the most rate-sensitive major sector in the U.S. economy, and this slide provides a comprehensive snapshot. As of December 31, 2025, the 15-year mortgage rate is about 5.44% and the 30-year rate about 6.15%. Mortgage originations, as of Q3 2025, are approximately $512.1 billion. Critically, serious delinquencies, mortgages delinquent by 90-plus days, remain low around 0.83% as of Q3 2025. That suggests household balance sheets are not breaking, even if affordability is tight. Now look at sentiment. The NAHB Wells Fargo indicators show prospective buyer traffic around 26, present sales conditions around 42, expectations for the next 6 months around 52, and the overall housing market index at 39. That is subdued. It reflects the affordability shock from higher rates. The bottom table ties it together. The Case-Shiller index is elevated. Housing starts and permits are moderate, new single-family homes sold are around 737, and pending home sales are weak with an index near 79. The direction is that activity is constrained, not collapsing. The way I see the portfolio takeaway, housing is in a high-rate hold. It is not a crash signal. It is a growth drag signal. For equity investors, this argues for selectivity in housing-linked cyclicals and banks with mortgage exposure. For bond investors, it supports the thesis that if there are rate cuts, they'll have an outsized impact on housing activity and related sectors. Advisors should communicate this clearly. The housing market is stabilizing, but it is constrained by rates. Any meaningful re-acceleration requires either lower mortgage rates or higher real incomes, ideally both. Until then, housing contributes more to volatility than to growth. This continuation slide focuses on housing prices and sales volumes. As of December 31, 2025, the median sales price for new houses sold is roughly $392,300, while the existing home median sales price is about $405,400. That gap is meaningful. It suggests that builders are competing on price and incentives to move inventory. While the existing home market remains constrained by limited supply and the rate lock effect, homeowners with low mortgage rates who are reluctant to sell. On the volume side, new single-family houses sold are approximately 737,000, while existing home sales are about 4.35 million. Existing homes dominate the market, so when existing sales are muted, it constrains turnover across the entire housing ecosystem: brokers, renovations, home goods, and local services. To understand the macro interpretation, housing is behaving like a supply-constrained market with weak affordability. Prices are holding up better than activity, because supply is tight. That combination can keep shelter inflation sticky even as other components cool. Another reason the Fed may be cautious. As it pertains to portfolio implications, avoid the simplistic view that high rates automatically mean falling home prices. The more accurate view is, high rates reduce transactions first. Price softness typically requires either a supply shock or a labor market shock. Neither is evident in the data here. For investors, the tactical approach is selective exposure to housing-adjacent companies with strong balance sheets and pricing power. For advisors, message discipline matters. Clients may hear housing is weak and assume housing is cheap. The data says otherwise. Prices are still elevated, and the opportunity set is more about cash flow quality than distressed pricing. Manufacturing and services give us a clean read on the two-speed U.S. economy. As of December 31, 2025, the ISM Manufacturing PMI is approximately 47.9, while the ISM Services PMI is about 54.4. The interpretation is straightforward. Manufacturing is in contraction territory of below 50, while services remain in expansion. This split matters because it explains why macro debates feel confusing. Manufacturing weakness is typically associated with late-cycle slowing, inventory corrections, and softer global trade. Services strength is consistent with a consumer that is still spending and an economy that is still producing nominal growth. In other words, parts of the economy are rolling over, but the dominant services engine is still running. For investors, the key question is whether services eventually follow manufacturing lower, or whether manufacturing rebounds as rates ease and inventories normalize. The path depends heavily on labor market resilience and policy. When I think of the portfolio implications in this environment, avoid overly cyclical exposure that requires a manufacturing rebound to justify valuation. Favor companies tied to services demand, recurring revenue, and pricing power. In fixed income, the manufacturing contraction supports the case for holding quality duration as a hedge, because growth shocks tend to pull yields down. In equities, it also supports a bias toward quality factors with strong margins, low leverage, and stable cash flows. For advisors, this slide is useful for client education. You can explain why markets can be up while parts of the economy feel weak. The economy is not a monolith. As we head into 2026, Monitor Weather Services PMI begins to decline meaningfully. A sustained move toward 50 is typically the point where recession risk becomes more than a tail scenario. Dollar dynamics were a meaningful macro tailwind in Q4. On the left, we see that one-year CPI change is about plus 2.65%, while purchasing power change for the consumer dollar is roughly negative 2.52%. More importantly, The ICE US dollar index is down approximately negative 9.4% year over year, and about 6.5% lower than Q3. That is a large move for a reserve currency, and it has real asset allocation implications. On the right, exchange rates illustrate the shift. The year's ranges show meaningful volatility. A softer dollar tends to support three things: international equity returns for US-based investors, emerging market performance, and commodity pricing, including precious metals. From a portfolio strategy perspective, dollar weakness is a diversification enabler. It reduces the U.S. asset dominance that characterized prior years and makes non-U.S. exposures more additive. It also supports holding real assets as a hedge against purchasing power erosion. However, currency is a risk factor, not a free lunch. Advisors should size international exposure based on mandate and risk tolerance. If clients cannot tolerate currency volatility, consider partial hedging. If clients can tolerate it, an unhedged global allocation can be a powerful diversifier when the dollar trends lower. The broader takeaway: the dollar is not just a macro headline, it is a return driver. In 2026, if fiscal deficits and rate differentials continue to pressure the dollar, global diversification and real assets should remain structurally supported. Portfolios built entirely around U.S. equity beta will be less efficient than portfolios built with currency-aware diversification. The consumer remains the critical swing factor for 2026. On the left, the personal savings rate is about 4.2%, well below the historical average near 8.56%. Total consumer credit outstanding is approximately $5.085 trillion. These data points tell you that the consumer is still spending, but the cushion is thinner. Low savings and rising credit usage typically reduce resilience to shocks, whether those shocks come from employment, inflation, or higher interest costs. On the right, retail sales year over year are around plus 3.1%. But real retail sales are only about plus 0.71%. The spread, roughly 2.39%, is inflation's quiet tax. Nominal sales growth looks fine, but after inflation, volume growth is modest. Consumer sentiment is low at about 52.9, down 2.2 points quarter over quarter and roughly 31.7 points below the 30-year average. That gap suggests a persistent confidence problem despite continued spending. For investors, this is an environment where consumer strength can persist, but it is increasingly dependent on employment stability. If unemployment rises, the low savings rate becomes a vulnerability. That would pressure discretionary spending, increase delinquencies, and widen credit spreads. When it comes to my portfolio strategy, I'm cautious with highly levered consumer discretionary names and lenders with subprime exposure. Favor businesses that sell necessities or have subscription-like revenue. In credit, focus on quality. For advisors, position this as a late-cycle consumer, still functioning, but with less shock absorption. The actionable framework is to watch real retail sales and delinquency trends. If real growth rolls over and credit stress rises, risk assets will reprice faster than most clients expect. Prepare portfolios now, while markets are calm, rather than react later. We now shift to bonds and interest rates, data that summarizes what happened in fixed income over the last quarter. In many cycles, equities get the attention, but rates do the real work. Rates determine discount rates, mortgage affordability, capital costs, and ultimately the multiples investors are willing to pay for risk assets. The key for Q4 is that the market began to price a more credible path to policy easing, but not without tension. Inflation prints improved, yet wage growth and fiscal dynamics remain constraints. In that context, fixed income becomes a strategic toolkit. You can harvest carry, build recession protection via duration, and control equity volatility through better diversification. In a late-cycle environment, we focus on three bond questions. First, what is the front end doing? That reflects Fed policy and near-term inflation expectations. Second, what is the long end doing? That reflects growth expectations and term premium, which is heavily influenced by fiscal supply and demand. Third, what are spreads doing? That reflects how much credit risk investors are being paid to take. As we move through the next slides, you will see evidence of easing at the front end, stability to modest increases at the long end, and credit yields that remain relatively tight. The combination implies that the bond market is pricing slowing, but not breaking, while also demanding a bit more compensation for long-term fiscal and inflation uncertainty. Portfolio guidance, in my opinion, is to not treat bonds as a single category. Treat them as exposures like duration, credit, and liquidity. In 2026, the best fixed income outcomes will come from intentionally choosing which exposures you want and which you do not. Interest rates and spreads tell us where the Fed is, where the market believes the Fed is going, and how that path is feeding into risk assets. On the left, The effective federal funds rate as of December 31, 2025 is about 3.64%, with the target upper limit at 3.75%. That framing is important. Policy is still restrictive relative to inflation, but less restrictive than earlier in the cycle, meaning the direction is easing, even if the level remains elevated. On the right, the S&P 500 level is noted at roughly 6,845.5, and the 10-2-year Treasury yield spread is around plus 0.71%. The notes highlight that the spread normalized on September 6, 2024 after being inverted since July 6, 2022. Historically, a long inversion followed by normalization has often preceded a meaningful growth slowdown. The sequence typically looks like this: inversion during tightening, then normalization as the market anticipates cuts and growth weakens. The portfolio message is that rates are no longer a simple tailwind. The front end reflects a Fed that is cutting cautiously. The curve reflects uncertainty about growth and inflation over the medium term. Equity markets, meanwhile, are priced for continued earnings resilience and a relatively smooth policy path. When I think about actionable strategies in fixed income, begin building a duration ladder rather than holding only short-term cash proxies. Cash yields are attractive, but they are likely to fall if the Fed continues to cut. In equities, avoid overpaying for long-duration growth solely on the assumption that rates will collapse. And in credit, recognize that spreads can widen sharply if growth deteriorates, even if the Fed is cutting. The objective is to earn carry while keeping optionality for a risk-off shift. This is the U.S. Treasury yield curve table, one of the most direct signals for portfolio construction. From September 30th to December 31st, the front end declined meaningfully. 1-month yields fell about 46 basis points to 3.74%, 3-month down 35 basis points to 3.67%, 6-month down 24 basis points to 3.59%, and 1-year down 20 basis points to 3.48%. The 2- and 3-year rates also edged lower, to roughly 3.47% and 3.55%. The belly was nearly unchanged. The 5-year is essentially flat around 3.73%. But look at the long end. The 10-year ticked up slightly to about 4.18%, and the 20- and 30-year moved higher to roughly 4.79% and 4.84%. That is a classic curve twist. Easing expectations are pulling the front end down, while term premium and fiscal supply pressure the long end higher. This has clear portfolio implications. First, cash and short-term yields are likely past their peak. If you are sitting in T-bills for yield, the carry is attractive today, but the reinvestment risk is real. Second, long-duration bonds are not a one-way bet. The long end is being influenced by deficits and issuance, so duration exposure should be added with a plan with laddered, diversified, and size to risk tolerance. From a strategic standpoint, this curve shape supports a barbell approach: maintain liquidity at the front end for flexibility, and add quality duration in the intermediate part of the curve where you can get meaningful yield without taking the full long end term premium risk. And for equities, remember, when the front end falls but the long end rises, it can pressure valuation multiples even if the Fed is cutting. That is a key risk for 2026. Corporate yields provide the second half of the fixed income picture, not just where risk-free rates are, but what the market is paying you to take credit risk. From September 30th to December 31st, yields moved modestly. AAA yields increased about 6 basis points to roughly 4.7%. AA yields rose about 6 basis points to about 4.59%. Single A yields were essentially flat to slightly down at around 4.69%. And BBB yields increased about 3 basis points to approximately 5.04%. The key takeaway is that spreads are not signaling distress. In a world where leading indicators are soft and the labor market is cooling, you might expect spreads to widen more meaningfully. The fact that they have not suggests complacency, or at minimum a strong belief in a soft landing. That creates a risk-reward challenge. If spreads are tight, the upside in credit is limited to carry, while the downside can be large if growth surprises to the downside. In other words, credit is not cheap insurance for income investors right now. It is a measured carry trade that requires discipline. The portfolio strategy is to stay up in quality. Use investment grade to harvest yield, but avoid heavy exposure to the lowest quality credit tiers where defaults spike in downturns. If you need more yield, consider structured approaches that control downside or use shorter duration credit to reduce mark-to-market risk. For advisors, this is the framing. Credit is not a substitute for equities, and it is not a risk-free income stream. It is a risk asset with different drivers. In 2026, if unemployment rises and earnings weaken, spreads will widen quickly. Make sure your clients are paid appropriately for the credit risk they are taking, and if they are not, reduce that exposure now, while markets are calm. We now move into charts of the moment. visuals that capture the trends impacting markets and investments. These slides are designed to highlight the narrative drivers beneath the quarterly returns, the winners and losers that define positioning, the dispersion that defines opportunity, and the policy and concentration dynamics that define risk. In late-cycle markets, headline index returns can be deceptive. Two investors can both own the S&P, yet have radically different experiences depending on factor tilts, sector concentration, and entry points. That's why we focus on breadth and dispersion. When dispersion is high, active decision-making and disciplined rebalancing matter more. When dispersion is low, beta dominates. In Q4 and across 2025, dispersion was high, meaning there were significant opportunities, but also significant traps. These charts also connect directly to forward guidance. If the market is increasingly concentrated and driven by a small set of mega-cap winners, the risk is not that those companies are bad. The risk is that portfolios become fragile, because one theme reversal can produce index-level drawdowns that surprise passive allocators. Conversely, when a year is defined by wide dispersion, it is often a precursor to rotation, where previously ignored areas become the next leaders once valuation gaps become too extreme and policy shifts change discount rates. As we go through the next slides, I want you to think in terms of positioning. Where is the crowd? Where is the margin of safety? And where do we have asymmetric payoff profiles? That is the core of the Pries capital approach. Build portfolios that can survive volatility and exploit dispersion, rather than portfolios that depend on one theme continuing forever. This slide highlights Q4 S&P 500 winners and losers, and the breadth statistics are the first thing to note. Only 248 constituents posted positive returns in Q4, which is about 49% of the index. That means more than half of the S&P 500 was down during a quarter when the index itself was up. That is the textbook definition of narrow leadership. The biggest winner was Sandisk Corporation, which more than doubled, up roughly plus 111.6%. The biggest laggard was Fiserv, down about negative 47.9%, among the 255 losing constituents. That's an extraordinary spread inside a single quarter, and it reinforces that we are in a high dispersion environment. Why does this matter for advisors and investors? Because it changes how you manage risk. In a broad bull market, index exposure is often good enough. In a narrow market, index exposure becomes implicitly concentrated, and clients can be surprised by volatility when leadership turns. It also means stock selection and factor tilts can materially impact outcomes, both positively and negatively. The portfolio lesson is to de-risk concentration and rebalance systematically. If your portfolios are heavily exposed to the same crowded winners, you may be overexposed to one theme, typically large cap growth or AI-linked narratives. You don't have to sell the winners, but you do need to size them. Concentration without a hedge is not conviction, it's fragility. The actionable takeaway: emphasize breadth in your equity allocation. Blend style exposures, increase international diversification where appropriate, and use risk controls, position limits, rebalancing bands, and explicit hedges, so that a leadership reversal does not force reactive selling. Q4's winner-loser dispersion is a warning and an opportunity. Warning of fragility, opportunity for disciplined allocation. The 2025 scoreboard reinforces the same theme, but at an annual scale, performance was defined by wide dispersion beneath the surface. In total, 321 companies in the S&P 500 finished 2025 in positive territory, which sounds healthy, until you recognize how uneven the gains were. Western Digital topped the leaderboard, up a staggering plus 283% for the year, followed by Micron Technology at roughly plus 240%. Those are not normal outcomes in a stable market. They are outcomes driven by thematic concentration, AI infrastructure, memory, and cyclicality tied to capex and demand expectations. On the downside, The Trade Desk and Fiserv were down about negative 67%, making them among the worst performers of the year. For investors, dispersion like this is a sign of both opportunity and risk. Opportunity, because mispricings appear when markets crowd into narratives and abandon other areas. Risk, because dispersion often comes with higher volatility and more abrupt regime shifts. From a portfolio construction perspective, this slide argues for process. If you don't have an active process to take profits, rebalance, and control exposure to high volatility winners, you will end up buying high and selling low at the wrong time. Conversely, if you have a disciplined process, dispersion becomes your friend because you can harvest gains and redeploy into undervalued segments. Advisors should use this slide to reset client expectations. A year like 2025 can anchor clients to unrealistic return assumptions. The proper response is to normalize expected returns, increase diversification, and upgrade risk management. In 2026, the market is unlikely to reward the same leadership with the same magnitude. Build portfolios to withstand rotation, not to depend on repetition. This slide addresses the Fed rate cut outlook, and it is one of the most important forward-looking issues for 2026. Q4 2025 delivered 2 additional rate cuts of 25 basis points each, following the Fed's initial cut in September. That totals roughly 75 basis points of cuts in 2025. The market is now debating whether 2026 becomes an aggressive easing cycle, or a slower conditional one. The macro backdrop is mixed. Unemployment has drifted higher to about 4.6%, a level not seen since 2021. Inflation remained tame in Q4 around 2.71%, slightly lower than where Q3 ended. On those numbers alone, a case for continued cuts exists. But the Fed's constraint is credibility. If wage growth remains above productivity and services inflation stays sticky, cutting too quickly risks reigniting inflation. That is the tightrope. The notes reference the CME FedWatch tool forecasting only a 5% chance of a fourth consecutive cut at January's FOMC meeting. That underscores that markets are not fully convinced of a straight-line easing path. Add a second variable: leadership risk. Fed Chair Jerome Powell's term ends in May 2026, and the successor choice could materially alter the reaction function. When it comes to the portfolio strategy, don't build a portfolio that requires one specific policy path. Prepare for multiple outcomes. If cuts accelerate, duration and rate-sensitive assets benefit. If cuts slow or reverse due to inflation, long-duration growth and levered real assets suffer. The right positioning is balanced. Maintain exposure to quality equities, add intermediate duration as a hedge, keep liquidity for opportunistic rebalancing, and maintain inflation hedges like commodities, pricing power equities, and precious metals. For advisors, communicate that policy is conditional. The Fed is not saving markets. The Fed is trying to balance inflation control with growth stability. Investors who respect that conditionality will outperform those who assume the old playbook. Index concentration is a structural risk that most investors underestimate because it hides inside diversified index products. The slide quantifies this clearly. SPY's top 10 holdings increased by about 0.36 percentage points quarter over quarter, with approximately 39.23% of the S&P 500 tracking ETF concentrated in just 10 names. In QQQ, concentration actually decreased by about 3.4 percentage points quarter over quarter, but it remains high. Around 49.51% of the Nasdaq indexed ETF is in the top 10 holdings. The right chart focuses on the Magnificent 7. The Mag 7 gained about plus 22.37% in 2025 despite experiencing a drawdown of over 25% in April. The remaining S&P 493 gained about plus 13.06%, pulling the entire S&P 500 up about plus 17.88%. This is the core point. Index returns are increasingly dependent on a small cohort. That increases fragility. If those names disappoint, whether in earnings, regulation, capex, or simply valuation compression, the index can fall even if the median stock is stable. It also means that many clients who own the market actually own a high-duration technology factor portfolio. You should know what I'm going to say for portfolio action. Diversify intentionally. Add exposure to value, international equities, and smaller companies with strong balance sheets. Consider equal weight strategies or active managers who manage concentration risk. And importantly, do not confuse concentration with safety. These are excellent companies, but valuation and positioning can still create drawdown risk. For advisors, this slide is a client conversation tool. When clients feel overconfident because the index always goes up, show them what they really own. The correct response is not fear. It is thoughtful diversification and disciplined rebalancing to reduce dependence on a single theme in 2026. Precious metals dominated Q4, and the move is telling. Gold surged past $5,000 per ounce, continuing a record year with multiple new all-time highs. Silver was even more aggressive, up roughly plus 45.6% in Q4 and over plus 100% for 2025. Those are extraordinary numbers for assets that are typically viewed as slow-moving stores of value. The key interpretation is not metals are hot. It is what metals outperformance tends to signal: rising concern about currency debasement, fiscal deficits, and geopolitical instability, combined with a softer dollar. The slide explicitly notes increased pressures weighing on the US dollar, and that aligns with the earlier dollar slide showing a meaningful DXY decline. For portfolio strategy, precious metals should be treated as insurance and as a diversifier, particularly in a regime where public debt is high and policy volatility is rising. Metals tend to perform best when real rates fall, when the dollar weakens, or when investors demand a hedge against systemic risk. Q4 suggests that at least two of those conditions were present. That does not mean chase the move with oversized allocations. It means reclassify metals from tactical trade to strategic allocation, sized appropriately to the client's risk profile. For many diversified portfolios, a modest allocation can improve convexity, meaning it helps in stress scenarios without meaningfully sacrificing long-term return potential. Advisors should also communicate expectations. Metals can be volatile. They can underperform for long stretches. The reason to hold them is not quarterly performance, it is regime protection. In 2026, if fiscal deficits remain high and the dollar remains pressured, metals may continue to be supported. If policy tightens and real rates rise, metals can cool. Size and rebalancing discipline are everything. We close with the Pries perspective, forward guidance grounded in the evidence we just reviewed. First, equities delivered positive returns in Q4 and in 2025 overall, but leadership is narrowing and valuations remain elevated. That combination is not a reason to exit markets. It is a reason to manage risk more deliberately. When passive exposure becomes concentrated and priced for perfection, your margin of safety comes from diversification and process, not prediction. Second, macro data is sending mixed signals. Inflation has cooled into the high 2% range, but wage growth remains firm. The labor market is softening gradually, not breaking. Leading indicators are weak, and manufacturing is contracting, while services remain strong. The most likely base case is slower growth with persistent policy conditionality, not a clean reacceleration. Third, the bond market's message is nuanced. The front end is falling as cuts are priced, while the long end is pressured by term premium and fiscal dynamics. Credit spreads remain tight. That argues for quality carry and intermediate duration, not aggressive reach for yield. So here is the forward guidance in my opinion. For 2026, build portfolios that can perform across scenarios. Maintain equity exposure, but reduce concentration and upgrade quality. Increase global diversification where appropriate, especially with a softer dollar. Reintroduce duration thoughtfully through a laddered approach, enough to hedge recession risk, not so much that you are hostage to long-end term premium. Avoid lower quality credit. It is not paying you adequately for downside. Maintain inflation and fiscal hedges through selecting real assets and a disciplined allocation to precious metals. Finally, discipline matters. Rebalance systematically on a rules-based approach. Define your risk limits before volatility returns. And remind clients of the goal, not to win every quarter, but to compound capital through cycles. Pries Capital's mandate is evidence-driven strategy, not narrative-driven reaction. That's how you preserve capital and create durable outperformance. And that's all for now. I'll leave as I always do. We have great challenges and great opportunities, and with our help we'll meet them together. Thank you and have a great night.